For decades, the Indian market followed the rule: use equities for growth and gold for safety. In early 2026, the Funds India Wealth Conversations report released data suggesting this traditional divide has shifted. Looking back 20 years from 2026, the Nifty 50 TRI delivered a 12.6% compound annual growth rate, multiplying wealth 10.7 times. Over that same period, gold delivered a 15.6% growth rate, multiplying wealth 18.3 times. This creates a dilemma. The traditional safety asset has significantly outperformed the growth asset, forcing us to decide if the stock market still has a primary place in a portfolio. By 2026, gold prices reached nearly 160,000 rupees per 10 grams. Global instability and sustained central bank hoarding are the primary driving factors keeping these prices at record high levels. At the same time, the Nifty 50 is trading at a high price-to-earnings ratio. When valuations reach this level, math dictates that future equity returns over the next few years will likely moderate toward the 7 to 8% range. These combined factors lead many to focus only on recent performance. There is a risk of treating a defensive asset as a permanent growth strategy just because it has had a strong run. It is easy to look at that 18-fold return and assume gold has become significantly more valuable on its own. Understanding these returns requires looking at purchasing power parity, which tracks how different currencies interact. Since gold is priced globally in US dollars, owning it in India functions as a hedge against the rupee. Most of those 18-fold gains reflect the rupee losing value against the dollar, rather than the gold itself gaining global buying power. Gold protects your current purchasing power from currency decay, but it does not produce net new wealth. Gold is a passive asset. It produces no internal cash flow and pays no dividends. Because it does not produce anything of its own, gold can go through long stretches where the price remains completely stagnant. Between 2011 and 2018, the return on gold was nearly 0%. During that same 7-year period, Indian equities doubled in value. Moving entirely into gold for safety means risking a decade of zero growth, while productive assets continue to compound. Buying equity means owning a fraction of a business that operates in the real economy. These businesses adapt to inflation by constantly creating new products and gradually raising their prices to cover their increased costs. This process generates the internal cash flow that powers long-term growth. This active generation of value is the fundamental difference between a productive company and the passive scarcity of gold. For those who want to grow capital over decades, equities remain the primary vehicle. We must acknowledge that the Nifty 50 is currently at peak valuations in 2026. These high starting prices make the projected 7 to 8% returns a mathematical reality for the near future. Investors today will need more patience than those who invested in previous decades. The choice is between accepting moderate growth in a productive asset or risking zero growth in a defensive one. Allocating too much to gold based on the last 20 years is like driving while looking only in the rearview mirror. You might feel safe, but you'll reach your goals much later. Gold and equity serve different functions in a portfolio. View our choices in two categories: wealth insurance and the wealth engine. Gold is insurance. It acts as a currency hedge and protects purchasing power, yielding nothing. Equities are the engine. They offer productive ownership and cash flow, but come with high volatility. A resilient strategy requires matching these tools to your specific timeline. Your ideal allocation depends on where you sit on this grid of time and goals. If you are chasing gold because of its recent returns, be careful. Buying an insurance policy simply because the premium went up is a mistake. Long-term accumulators should accept the lower equity projections for now. Maintaining a heavy allocation in the wealth engine is necessary to keep compounding over time. For those nearing retirement, the goal changes to preserving what has already been built. In this specific case, gold's ability to hedge against currency value is highly useful during 2026's geopolitical instability. Successful investing requires distinguishing between the need to protect the wealth you have and the need to build the wealth you want.
Let's discuss that in the comments section. And as always, thanks for watching Alux Live. Subscribe for more.